How do you invest in a great business? We're going to tell you about 5 steps you need to take to get it right according to a successful investor. And he'll share a list of 6 stocks he likes based on those steps. So let's get started. This is Ticker Take. What you doing, Caroline?
Oh, hey, John. I'm just getting my steps in. You know, it's very important to get your steps in every day.
Absolutely. Whether you're working out or investing. Our guest today is Paul Harris, a successful investor in part because he has followed 5 key steps.
Yes, and Paul uses these steps to identify great businesses for investors to target, which is easier said than done.
True. Now, coming up, we will get 6 stock ideas from Paul, but first he explained his investing process. Paul Harris, thanks so much for joining us on Ticker Take.
My pleasure. I'm glad everything's going so well for you. I see you all the time on everything.
Well, we're having a lot of fun in building this, and a lot of people ask us about this concept of investing in great businesses. And of course, everybody wants to invest in a great business. But you were telling me about a study that was done, which highlights just how hard it is for investors to identify great businesses because they're few and far between. Can you tell us more about that?
Yeah. So the article is the white paper by a gentleman named Heinrich Bessenbinder, and he's a professor at the University of Arizona. And he went back and looked at returns in the stock market from 1926 to 2018. I think he's updated it since, but I think that's the main paper. And what he found was that there's only 4% of the stocks in the S&P 500 that have actually given you all the returns.
4%.
Right. So 4% of the companies have done that. So this is the issue for me, right? I guess maybe when I read the paper, it was my, Warren Buffett had his Charlie Munger moment.
Yeah.
I had my Henrik Bessenbinder moment. And so what happened was I realized that I was thinking about all these things in the wrong fashion, right? That's the job of as a portfolio manager, is to look for great businesses.
Yeah.
And the reality is there's not that many. Just because the stock market is out there with thousands and thousands of stocks doesn't mean they're all great businesses. People bring companies public because they can get wealthy. There's all kinds of other reasons why they do it. But the reality is that great businesses are hard to come by. And that is my job, I see, is to kind of figure out what is a great business, what characteristics that they have, and try to own them for the long term, right?
So let's get into that because there are 5 steps in particular, 5 metrics that are really valuable to you. And I'm going to mention them now. So gross margins, operating margins, return on invested capital, free cash flow, interest coverage ratio. A lot of these are terms that we've talked about in different Ticker Take videos. And I would really encourage people to go out, learn about each one and what makes a company outperform on each of those metrics. But when you put them all together as an investor, why does that collection work for you in assessing great businesses?
So I think that they all kind of talk to different parts of the company, right? So gross margins, for example. I mean, what does a gross margin mean? It means that if you make $1, if you have 80% gross margins, if you make $1, you get to keep 80 cents of that, right? Which is very powerful in my view, whether we're in an inflationary period, whether we're in a difficult stock market thing, those things protect you, right? So, but they all speak to different parts of a company. So, interest coverage speaks to the balance sheet, right? Whether they have a strong balance sheet or not. Free cash flow speaks to the cash flow statement. Are they generating free cash after they pay all their capital expenditures? And are they growing that free cash? So for me, the importance of those metrics, if you put them together and you find companies that actually are consistent with those at the very least, but on top of that are growing those metrics, right? They can't do it all the time, but continue to kind of grow the metrics over long periods of time. They end up being better companies. And if you can buy those, if you have a set of companies that do that better than the index, my argument would be that over a long period of time, you'd outperform the index. So that's really what I think about. And on top of that, I think what I found with this is that if you own these great businesses and they have these metrics, over the long term, they give you less volatile portfolios. So if you are in an environment where the stock market is having a difficult time, these stocks, because of these metrics, will protect you on the downside. So it's really about building a portfolio of these companies, and there's some nuances and all that stuff, but if we take it at face value, if you build a portfolio with these companies in it, I think over the long term, you'll get better rates of return. You will also get lower volatility in your portfolio. And I think that is what we're all trying to seek in the long run and then what you want to be able to do is the last part of it, obviously, is, hold them for the long term, because these companies because of those metrics, have a great ability to compound internally. And if they're compounding internally, so some of them don't pay me dividends, of course, but I would say that they're better off using that money to reinvest in their businesses, right? Which they can do at a much higher rate than I could. So really it's buying these businesses. And there's, like I said, there's not that many of them and it's hard to seek them all out. And, when you tell somebody, oh, I look for great companies, it sounds very trite, right? So, but the reality is it is a hard job to do. And that is my function as a portfolio manager. And that is what I try to achieve over the long run, is finding these companies on an ongoing basis.
All right. Now that we know Paul's 5 steps to investing in great businesses,
let's get 6 stock picks from him of companies he thinks are great businesses. But first, a friendly reminder, this is not financial advice.
Stock number 1, Alphabet.
Well, kudos to you, because I remember talking to you like a year ago, where you were building a case for why Alphabet could be a great business as an investment for the long term. And we saw a lot of value unlocked in Google's parent company last year. Right. What makes it still a great business to own as an investor today?
Well, I think so. If you can talk from a fundamental and those metrics, I think they certainly have a lot of those metrics. That's one thing. The thing I think that's very important about Alphabet is that there were a couple of things that people thought they were going to disappear. One was their search business, which really has not disappeared. And in fact, what happens with ChatGPT more often than not is students are using it to write their essays as opposed to looking at for the next restaurant or things like that, right? So I think that search business continues to be there and grow, number one. Number two, I think the cloud business they have this great cloud business, like that, although they were late to the business relative to, Amazon and Microsoft, they've kind of not caught up, but they're definitely third in cloud. So that business continues to grow. And their advertising business, and digital advertising is where it has to be. Like you're not getting paper advertising anymore. Digital advertising is where people are moving to, and it's growing and growing. And also people don't give them credit at all for Waymo. And people talk about Tesla and driverless cars. I mean, they're just in Austin, right? I mean, these guys have been all over the place, and it's so they've got several great businesses that are continuing to grow. And I think that on the AI side, I think that people felt they were way behind, but I think they've caught up. And I think that Gemini 3 will be that's a stepping stone to get to better things. I think the issue with AI, though, is what we have to see is, not just in these tech companies. The problem with it is just people just look at it in the tech world only. But AI, if it's really going to be fascinating and grow and become, it has to spread to all these other industries. And I think that's why Google has this great opportunity, because they're in a sweet spot to be able to help other companies do that in the same way that Microsoft would probably be able to. Right. So their generative AI issues are not just stuck with advertising and all these other things. They have this opportunity to make it ubiquitous. And I think that's when the AI becomes the most important thing that we'll have in the world, right? So other businesses have to be using it at a full level, not that, I'm just using it for my emails, right? So I think that's the value that they still have, and I think it will continue to grow and do well here.
Stock number 2, Amazon.
Well, Paul, we're probably feeling like a broken record to our Ticker Take audience talking about Amazon. It comes up all the time. And yet, as I've said many times to our audience, it's still one of the most loved stocks on Wall Street. And I think a lot of investors who come on Ticker Take see a lot to like in Amazon. What do you like?
So, what I like about Amazon, so, they were laying off 30,000 people. They announced that thing. So clearly Amazon is using AI in a big way internally. And those jobs are not going out from the warehouse. They're actually, white collar jobs that are being taken away. So that's one thing that I like. They're using AI to facilitate better revenue cost relationship in their business, which they've always been very good at. So I think that the Amazon story is very simple. They've got 3 really great businesses. The first business is their retail business, which continues to grow. I mean, here's a company that is better at logistics than FedEx and UPS today, right? So they've got this great ability. And I think by the end of this year, in many big cities, they'll be able to deliver stuff less than 24 hours. So to me, that business continues to grow. They're the second, depending on how you look at it, the second largest retailer in North America. The second business is their AWS business, which is a cloud business, which they've been a leader in. It started with they had this excess capacity and they decided to start a business and they've done incredibly well with that. And I think still today, a lot of mid-sized and small companies go to them to use AWS. And the final business, I think, which people have not thought about and which is, I think will be very large, is their advertising business, right? They know exactly what you bought, when you bought it, when you need to get it again, all these other things. And so they can use that data to be able to, to really offer people a lot of better quality products, but also products that they need. So I think those three businesses are very important to them. I mean, yes, they have some other auxiliary businesses, which I don't really think about as much, but those are the three major businesses, and they continue to grow those businesses quite well. Again, like I mentioned with Google earlier on, where we get the value not only in Amazon itself about using AI, but outside when more and more companies start to use it more effectively, their data is more viable to access and to be able to give them more information. I think that's when you'll see these companies continue to do very well. And I think that that's the end result of all the stuff that we're working on in AI is to be able to get more and more, and what I mean by kind of real industrial businesses, chemical companies, healthcare businesses, all these other businesses to use it more effectively. Now, there's a downside to that. Maybe it's less people having to work there, but the other upside is that they'll be able to do many different things at a better level, faster, more productively, right? So I think that's the goal, kind of. And I think Amazon is going to be one of the players in that.
Stock number 3, Visa.
Well, the thing with Visa, which is always fun to look at, is just how profitable they are. But also when you look at the stock performance, like even the last decade, this was a reliable way. If you were looking for better performance than the broader market, you could have gotten it with Visa. So what do you see as the great business / great investment here?
So, Visa is like the 407. It's just a toll booth, right? So people go through it. You have a Visa card, Visa gets paid something. So they don't take any credit risk whatsoever. The bank takes the credit risk. So even with these things about, I think the stock went a little bit down a little bit when Trump came out about freezing interest rates on credit cards at 10%. That doesn't affect Visa at all, right? I mean, yes, Citibank or whoever owns a Visa card, supplies a Visa card to their clients would have to worry about that, but not Visa, right? But so the issue for Visa is that because of this toll booth, they get that. The one risk to them, I think, is this swipe charge, which they charge to use their card. And there's gone on about they're in court with this, and they hopefully will settle this through some kind of payment, I suppose, at some point in time. But the beauty of this company is that there is a massive network that they built over time, and there's only 2 other people that have it. Well, 3 technically, but 2 big ones, MasterCard and Visa. And everybody that puts through a credit transaction has to go through that. The other thing is that we think about maybe in this country or in North America, people using Visa cards all the time for everything, but there's a large percentage of the world that actually uses a lot of cash. So, there's this opportunity to grow internationally, to continue to grow internationally with Visa. And the other thing I think that is really important is that Visa has a great opportunity in B2B, which is small businesses, effectively, not larger businesses. But for someone like me, who has a small business, I use my Visa for everything, and it's attached to a bunch of points, so that whole point system forces you to use Visa more and more. And I think that years ago, if you wanted to pay your accountant or your lawyer, they didn't take Visa at all. You had to send them a check. Today, they all take Visa. So, you know what I mean? Those big professional charges end up going on your Visa card. So I think there's this kind of this widening out of the acceptability of using it at a professional level, not just at a retail level. That's one thing. I think that there's great opportunity internationally for Visa still. I think that their kind of network is very solid. Now, there's always talk about, other technologies are going to come in and take away their business. And this is not a company that says, no one's going to take away our business. They have been very proactive in the area of stablecoin and all these other areas that may affect them in some way or form. So to me, they have this kind of foresight to understand that the world is changing on that side. Their network is very powerful, but it could get damaged, but they're keeping on top of that and moving forward. So I would say the big risk is the swipe charge, which they're in court with right now, and that may have some damage to them, but I think it's much more of a cost damage. May have to pay a bunch of money, as opposed to necessarily causing problems with how those swipes going through their network. So I think that's why you want to own Visa. It's really just a toll booth. It's a duopoly. There's nobody else. I guess if you think of American Express as another one, but Visa is kind of the big brand that exists out there along with MasterCard. So I think it's a really stable stock in many ways. It hasn't done that well this year, last year rather. So I think it's a great opportunity to buy it at these levels.
Stock number 4, FirstService.
Okay, a company that people might not know as much about. Real estate services would be what this business in a lot of ways encompasses. But I was looking at the performance of the stock, similar to Visa, like a decades-long return that is very, very respectable. What makes it a great business?
Well, so I've liked this company for a long time. Jay Hennick, who people may know, started this company. He used to clean pools.
Yeah.
So he started this business. And so there's two parts of the business. The first part is the kind of servicing business on the real estate side. So not only do they take care of apartment buildings and that sort of stuff, a large part of their business is gated communities in the United States. They do the lawns and stuff like that. So on that business, what they've done is that they've grown two ways. One is they grow organically, and also they grow by acquisition. So although they're one of the largest players in the market, their market share is relatively small because there's a lot of mom and pop businesses that cut lawns and stuff like that. So they've been very good job of slowly acquiring more and more of these businesses around the United States specifically, and growing them quite nicely. So that's one part of the business. The other part of the business is what they call franchise business. So you've probably seen California Closets, that's their franchise. Paul Davis, which is an insurance business where, if you have a hurricane or something, they come in and fix your house up or water damage. So they have that business. They have a couple of others in the franchise business as well. But what I like about this company is that, one, they've grown by acquisition, and they're very strict about how they acquire things. And the problem is, and I think you've probably seen this over your many years in the industry, these growth by acquisition stories, all of a sudden they make a massive acquisition, they can't manage it, and the whole thing falls apart. But they've been very good because they tend to be smaller acquisitions, and they integrate them very well. And I think that works really well for them. And I think the other thing is about this business, which is very key, is that when they sign these contracts on the servicing side, they don't tend to be for 1 year. They tend to be for several years. They have to meet certain requirements, but they tend to be for several years. So you've got a bit of an annuity that comes to you on an ongoing basis. And they have an inflation part of it too, that they're allowed to increase prices over a period of time. So it's a really great Canadian company that not much people know about. It's always been very expensive. It's fallen a lot over the last little while. I think it's a great time to buy it. They're great operators. Scott Patterson has run after Jay Hennick left the business. I think he's the chair still. Scott ran it, and Scott's a really great person. He kind of reminds me of Isidore Sharp, that used to knows everybody's name and stuff like that in that fashion.
The executive behind Four Seasons.
Right. Yeah. Yes. So he's very, very good, and he knows the company and he knows the businesses incredibly well. And so I think it's a great business. I think that they are a great Canadian company that sometimes gets overlooked because it's relatively small, but it has great dynamics to be able to grow over the next little while. And, through acquisition, through organic growth, they continue to grow quite well.
Stock number 5, Bank of America. All
right. B of A is also part of a larger call you have on being bullish on U.S. banks. But I guess give us the B of A great business story.
Yeah. So I think one of the reasons I like U.S. banks at this point in time, I've liked B of A for a long time, but I think that there's a sort of this dynamic that's changing with the administration in the U.S. presently. So they've loosened the capital requirements for banks. So which means that they, after 2008, they were there were a lot of capital restrictions on them. So those are slowly coming off. it's a good thing, but also a bad thing because, banks sometimes tend to take on more leverage when they take off capital ratios like that. So we've got to be cautious. But in Bank of America, Brian Moynihan went through 2008, so I think he would understand not taking on too much leverage. But there's a unique opportunity that's happening in banking today, right? Number one, on the capital market side, I think in 2006 you're going to see some of the largest IPOs that we've ever seen, whether it's whether it's SpaceX, whether it's ChatGPT or OpenAI. These big AI companies are all going to be coming public in some way or form over the next little while. The volatility that's created because of the administration, whether it was, April of this year, last year rather, that creates volatility is great for investment banking. I mean, capital markets. The volatility allows them to make lots of money, right? And so that's really important. I also think there's going to be a larger percentage of M&A going on that you haven't seen before, simply because, again, the administration seems to be very eager to do more of these things and allow them to go through with less restrictions. So I think companies, as you've seen, are eager to do M&A, but they weren't able to do it during the Biden administration because they thought regulatorily they would have lots of trouble putting the deal through. But I don't think that's the issue today. And finally, I think that from an M&A perspective, in banking, and I don't own a regional bank, I own Bank of America, but regional banks are going to be able to emerge because, as you know, John, banking is really a scale business. And so, there's way too many banks in the United States, and you've seen a lot of banking M&A go through. So I think there's a lot of things happening on the banking side. Yes, this issue where, Donald Trump wants to put a 10% on credit cards, interest rates and stuff like that, which may hurt banks shorter term. But I think that longer term, these aspects of where the power for them to grow and where they get lots of return on equity, those areas are being loosened up. And so there's a lot of opportunity for them to do well. Now, saying all that, they have lots of capital. And so which means that they can, if they decide not to expand into other businesses, they can certainly buy back their shares and increase their dividends, right? So you get that added effect of what's happening to their stock. So I think it's they're in a very sweet spot. And so, those money center banks like Bank of America very rarely would trade at, they've traded below book in 2008. They will trade maybe a book and a half times, 1 times book, 1.5 times book. But I think there's an opportunity where they may actually trade at 2-3 times book in this cycle. And so I think that's the opportunity for them. I know you have to be cautious about their balance sheet and making sure they're not becoming over leveraged. But I think this is an opportunity over the next couple of years for these banks.
And stock number 6, Meta.
Okay. In Facebook's parent, we have a company that over time has shown just how much profit power they have. So I would imagine that's one of the reasons why you see a great business for investors here. But you tell us.
Yeah. So, I mean, when we talked about those metrics, Meta has those things in spades, right? So, high gross margins, high operating margins, great free cash flow growth, all those things that I look for. I think one of the issues, so when it comes to Meta, I think one of the risks you have, let me talk about the risk first,
Sure.
is that they they get into these kind of periods where they kind of overspend in something and they take on too many people and all these other things. And Mark Zuckerberg kind of goes overboard on how he spends on certain things. But saying all that, Meta is a very interesting company to me presently because they can get the most benefit out of AI right away on the advertising side, right? Whereas, for example, a Microsoft, because they deal with large institutions, would probably take much longer time to get the value out of AI, where you're seeing that presently in Meta, where they're able to use AI more effectively on their advertising side, as I mentioned with Amazon as well. So they can get the benefit of AI and all the money they spend it. And you're seeing it already in their numbers that they're getting the benefit of being able to advertise very effectively, whether through Instagram or through all their kind of agents that they have that they're out there. They're able to do that very effectively. And so I think if you're playing AI right now, Amazon on just one part of their business, but Meta on all their business, because it's all advertising, can get a really great benefit out of it. So my worry is that, they spend too much on certain things. And I think that's the worry generally with AI today. But I think Meta gets a lot of value out of it very, very quickly. So I like that aspect of it. And it's not trading at an expensive level today. And I think they're they're showing that in their earnings numbers that are coming out. So I think that's the value you get out of Meta. It's much more, and you can see it happening right away. I think with some of these other places, it takes a little bit longer. But I think with Meta, you can see the benefit of AI in their businesses and how they can use it very effectively.
All right. Some really helpful perspectives. Paul, thanks very much for your time today.
My pleasure. Anytime. Hope I get invited back.
Thanks for watching here on the BNN Bloomberg YouTube channel.
TickerTake has its own YouTube channel. You can find a link in the description. See you next time.